And T has had a monster run.
In 2025, we saw the stock soar nearly 80% as it finally stepped out of Nvidia's shadow. But as we sit here in the first week of 2026, the cracks are starting to show. Is the AI party over? Today, I'm breaking down the bear thesis for AMD, where I think the price is headed, and why I just sold a January 2020 $60 put option for my wife's portfolio. Let's dive in.
Look, I'm a fan of Lisa Su, but we have to be intellectually honest about the numbers.
Here's why the bears are winning the argument right now. First, valuation versus reality. AMD is currently trading at a forward PE that is significantly higher than the broader S&P 500, while the growth is there.
The market has priced in a perfect 2026 if revenue growth even slightly misses that 35% target.
The multiple compression will be brutal. Second, the Nvidia Vera Rubin shadow. Nvidia isn't slowing down with their Blackwell ramp up and the upcoming Vera Rubin architecture. They are maintaining a performance lead. AMD's Instinct MI325X is a great alternative. But in the enterprise world, good enough is often a hard sell against the industry standard. Third, the ROI question.
In the closing weeks of 2025,
we started seeing hyperscalers like Microsoft and Google get questioned by shareholders. Where's the ROI on all this at CAPEX?
If the big spenders tighten their belts in 2026,
AMD, being the second place player in GPUs, could see the sharpest drop in orders. So, if the bear case plays out, let's say we get a NASDAQ correction or a lukewarm earnings report in February, where does the stock go? Right now, we are hovering around $214. From a technical perspective, there's decent support at $180. But in a true bearish valuation reset, I'm looking at the $155 to $165 range. This isn't just a random number. $160 represents a roughly 25% correction from current levels. Historically, this is where AMD's valuation starts to make sense for long-term value investors again.
It's the safety net where the risk to reward finally flips back to the bulls.
Now, let's talk about the trade. I recently sold a January 2026 put option at a $160 strike from my wife. If you're a bear on the current price, why sell a put?
Two reasons. One, passive income.
By selling this put, we collect an immediate paycheck or premium. Since the stock is way up at $214, the $160 strike is deep out of the money. We're essentially getting paid to wait for a crash that might not even happen. 2, the built-in discount. As a husband looking out for his wife's long-term wealth, I don't want her buying an MD at $214. That's too risky.
But if the bears are right and MD drops to $160,
I'm happy to own it there. If the stock hits $160, we are obligated to buy it. But we're buying a world-class company at a 25% discount from today's prices. It's the ultimate win-win for a conservative portfolio. Either we keep the cash, or we buy the dip at a price we actually like. The 2026 semiconductor market is going to be a battlefield.
While the AI transition is real, the prices aren't always rational. I'm playing it safe by using the market's volatility to generate income rather than chasing the green candles.
What do you think?
Is $160 a realistic floor for MD? Or am I being too optimistic?
Let me know in the comments. And as always, I'm not a financial advisor. This is just how I'm managing my family's capital. See you in the next one.